Erin, starting with you, can you talk about our overall risk profile in multi-asset portfolios given where we're at in the cycle?
We're overweight risk in our portfolios on the back of the view that we're in a mid-cycle environment, and we generally prefer equities over other risk-oriented asset classes in mid-cycle environments. After the strong rally that we saw over the past year, we're really emphasizing tactical flexibility along with sector and security selection in portfolios.
Thanks, Erin. Drilling into individual asset classes, Geraldine, can you talk about PIMCO's views on equities and credit?
Above-trend growth is a supportive environment of risky assets like equities or credit, where we have an overweight stance. That said, on valuation grounds, equities are looking a little cheaper and our overweight is bigger. Looking more precisely into equities, we are long those sectors and companies that are going to enable this green and digital recovery, paying particular attention to those ESG factors. In terms of region, this tilts us towards the United States, Japan, and emerging market Asia. And when looking at sectors, we could mention in particular semiconductors and green technologies. When it comes to credit, we are cautious on generic corporate credit. That said, we do find a certain numbers of opportunities in housing-related credit, in particular non-agency mortgages and UK RMBS. We also like other securitized credit, like AAA CLOs in Europe. Last but not least, there are also some reopening sensitive corporate credit where we do also have exposure, as well as select external debt from emerging markets.
And staying with you, Geraldine, how about our view on rates?
We are slightly cautious when it comes to duration, since we think central banks are going to very slowly remove accommodation and we've reached that peak. That said, we don't think that rates are going to sell off dramatically, and we see them evolving inside a range. Currently, interest rates are at the bottom part of this range, and therefore, this warrants a tactical underweight stance. That said, we will be ready to dial up and down our exposure depending where we find ourselves, since fixed income is potentially the great diversifier in an asset allocation portfolio. In terms of region, we favor the dollar block as well as specific emerging market local rates.
Thanks, Geraldine. Erin, back to you. Can you talk about our active currency views?
Mid-cycle environments tend to be periods of dollar weakness. And in fact, when you look at the dollar relative to either developed market currencies or emerging market currencies right now, the US dollar screens pretty rich on a relative valuation basis. As a result, we're moderately underweight the US dollar, particularly against other developed markets. However, we do think that you need to be gradual in your approach in terms of scaling into emerging market currencies, particularly since the overhang of the COVID pandemic still continues to disrupt many emerging market currencies. So we're really looking to be selective and starting out with being long emerging market currencies in CEMEA and Eastern Europe. And we'll look to gradually increase that position as we navigate through the back half of 2021, as well as into 2022.